What's up, everybody? Joe Brown here with Heresy Financial, and I've got a great guest on the show today, Jim from Wall Street Silver. Jim, thank you so much for joining us today.
Hey, Joe. Great to be here. Thanks.
Yeah, absolutely. Well, I would like to get started here. We're going to talk about a number of very relevant topics to what is going on right now regarding interest rates and silver, and even the reverse repo facility at the Fed, how that's going to play into things moving forward. But I do want to have a little bit of an introduction to the kind of the Wall Street Silver story here, because it's really amazing how fast you guys have been blowing up. And so I just want to hear briefly, can you tell me the recent Wall Street Silver story?
Yeah, so Wall Street Silver was a spinoff from, everyone knows what happened with GameStop last year, about a year ago this time, where on Wall Street Bets on Reddit, there was some sort of short squeeze going on with GameStop. And a lot of people missed out on GameStop. The stock was already at $400 a share during that short squeeze. So people wanted to talk about other stocks. And one of them was a silver stock, First Majestic, or some other silver, silver, the metal, is heavily shorted. But the people on Wall Street Bets really didn't want to talk about that subject. They wanted to stay focused on GameStop. They thought any other subject was a plot by the hedge funds to distract everyone. So
Sure.
they were banning the people on Wall Street Bets were banning everyone. And so we started Wall Street Silver, and Wall Street Silver is another subreddit on Reddit. And we're up to in the past year, we're up to 180,000 members on Wall Street Silver, just talking about our topic, silver investments, gold and silver, mining stocks, funny memes, financial data, news that affects this topic. It just became a big thing on its own. We were covered on CNBC a few times, Reuters, Bloomberg, a few different, national media, mainstream media picked it up. And it's just sort of expanded on its own. And then we started our own YouTube channel also, Wall Street Silver on YouTube. And we had you on. I think it was about 2 weeks ago, we had the infamous Joe Brown over there to talk about one of your things you did. Bank of America, the 800 million ounces short, and your video on my channel got 39,000 views. So it's one of our best. I'm a much smaller channel than Heresy Financial, but it got a lot of views for my channel. So you're famous, Joe.
Sure. Well, the bald head must have been helping it out, but no,
Yeah.
your channel has been growing very fast, and I've been really excited to see it because number one, I really like how the kind of the branding and the movement here is, a lot of people are feeling more and more comfortable with putting it out there, saying, I'm stacking silver, and really it's kind of changing, in my opinion, the perception on the reasons why and the type of people who buy silver. And so that's exciting to me. And then number two, the channel, you're really been, it's amazing the caliber of guests that you have on there. You just pretty much everybody who's everybody you've had on there, really starting to rival very quickly, the big interview channels like, Kitco and things like that. So it's really cool to see you've got some of the best interviews on YouTube right now.
Yeah, we have been getting a lot of good ones, and success breeds success, but some big fund managers, Lawrence Lepard, Willem Middelkoop, even people like we had Ron Paul on a few months ago.
Wow.
Which was really exciting. Or we get CEOs from big companies, Keith Neumeyer from First Majestic. He's always a great interview. And your channel's more of a explainer channel. That's why I watch your channel. You figure out a topic that you want to understand, then you explain it to your audience. But you're also doing some interviews too on your channel, which I think is a really good evolution for your own channel to do. Because I don't think I could do what you do, where you're just talking to the camera, explaining things, just you solo. If I tried to do what you do, I'd run out of content in 2 or 3 days, and people would be saying, Jim's repeating himself, it gets boring. So I'm not creative enough to sit there like you do and just create content every day. So I find that very impressive about your channel.
Sure. Well, it always helps to have interviews and conversations like this. So I appreciate you coming on here. But yeah, in terms of what's going on in the market right now, I wanted to talk about interest rates because the kind of the narrative out there's two opposing narratives. One is like, all of the people who, distrust monetary policy and fiscal policy are saying the Fed can't taper. There's tons of people who the classic line is you can't taper a Ponzi, right? They're going to try and raise rates, but they won't be able to. They're going to cause a crash. Then there's the other side, which is like, some of the big banks right now are saying, basically the market is priced in 6 to 7 rate hikes just this year. And so there's two different opposing narratives going on right now. What is your take on that? What do you think we see with interest rates moving forward through this year?
Well, on my channel, we're asking the question, how will this affect gold? How will this affect silver prices? Because the default presumption a lot of people have is if interest rates are going up, that makes gold or silver less desirable because they don't have a yield, whereas interest rates on bonds do have a yield. If rates go up, bonds become, after rates reach a certain point, bonds become more attractive. But there was just a recent article by Craig Hemke where it's on the article, if anyone wants to find it, it's on Sprott Money. You go to Sprott Money and go to Insights, News, and you'll see this article there on rates and gold. But on there is a really interesting chart here. And what Craig did was he showed during the last interest rate hike cycle, 2004 to 2007, we saw interest rates rising in this time period. And this is what the price of gold did during that time frame. It went from 400 to, over 700. So it's over a 70% increase, 75% increase in the gold price. And then here in the 2015 to 2019 Fed rate hike cycle, it went from 1,100 up to over 1,400. So just to put that in perspective, a rate hike cycle is actually historically positive for precious metals prices. So it's not something to be feared, it's something to be anticipated.
Well, I love that visual. That's a fantastic visual. And I'll probably be sending out this article then in my weekly newsletter at the end of the week here. But I love being able to see that just quickly at a glance. This is the time frame that rates were going up. And this is what the gold price did during that time. And it's again, it's kind of like in contrast to the expectations over the last year, 2 years, people were expecting gold to move up with inflation, but gold and silver were moving sideways or down in anticipation of these rate hikes. And it looks like once the plan to taper the balance sheet and start to raise rates started to, got solidified, we've only seen strength out of the metals since then.
Yeah, it's like they sniff it. Gold seems to sniff it out way before it actually happens. Like the inflation didn't really show up until the past, let's call it 6 to 9 months. It's when it really started showing up in the numbers. The CPI, which a lot of us believe is fake. We call it the CPI, because it's so manipulated downward. Right. But gold sniffed it out in from 2019 to 2020. Gold had this run from 1,400 all the way up to 2,000, almost a year and a half before it actually showed up in the inflation numbers. And that's historically true. Gold sniffs it out first. So what you saw last year was gold consolidating, more going sideways in that 1,800 to range. And that's interesting. The previous highs were all at 1,800 and then it fell off. So the fact that gold has stayed so high in this 1,800 plateau for so long, it's, all the gold mining stocks and the silver mining stocks are just printing money hand over fist. I saw a chart recently that after accounting for inflation, the gold mining sector is the only cash flow positive sector in the S&P right now.
Wow.
But once you account for inflation, for real inflation, once you, it's a guy named Tavi Costa on Twitter. He posts these graphs. So if you're looking for positive yield on cash flow, it's the gold and silver mining sector right now, one of the best sectors in the market. But the market doesn't recognize that. It's like these stocks are all beaten to hell.
Right.
And as a result, and I mean, it's just ridiculous what's going on.
Yeah, no, it makes a lot of sense, especially given where interest rates are compared to inflation. You've got this big adjustment, and investors are just now starting to kind of have to take a look at, from the institutional side, even taking a look at, hey, this inflation looks a lot more persistent. And so we can't rely on the fact that this inflation is going to go back down to 2% within a year. And so if we've got investments that, our expectation is 3% or 4%, maybe we had them because we were expecting, that this inflation was going to go away. But if it's not going away, we've got to start looking for higher yield. We've got to start moving our portfolio into something that's going to at least keep up with inflation so that we're not burning purchasing power.
Mm-hmm. Yeah, and that's the big question as to what sector is that, and where do you find that? Because it's not in bonds right now. I mean, even though the 10-year bond has gone from 1.3 to now 1.9, I mean, if inflation's, they admit to 7%, but if they really calculated it correctly, like if they counted housing the way they used to, not this owner's equivalent rent, which is so ridiculous. But I'm sure you've covered that on your show before. But
I don't know if I have.
real inflation right now is probably above, if they just made that one change, how they counted housing in the CPI number, it'd already be over 10.5%. So the real inflation's probably somewhere between 11 and 12% or more. Different people calculate it different ways, but it's certainly higher than whatever the federal government's telling us with CPI.
Sure. Yeah, 100%. And part of the reason that it seems like they're kind of designing it this way and implementing their policy this way is because they need to at least make a show of attacking inflation. But they know if rates across the board get too high, then that could cause things, especially too quickly, that could cause things to start to break. And so I'd like to look at the reverse repo facility, which you and I have talked about a few times together. This reverse repo facility, let's talk about, how that started and the reason for it. And then if they ever want to shut this off, what that'll do to rates.
Yeah, looking back historically, it really was never used that much up until last year. It was wasn't used at all before 2013, at least not as far as they have on the data. A little bit over this time frame, kind of modest, no big huge numbers. But then something happened in 2021 in March where it just launched. And I believe you covered that. What was the main reason at the beginning that happened? Something about collateral?
Yeah, so at the beginning in March of 2020, there was a supplementary leverage ratio that was suspended so that banks wouldn't have to worry about the collateral because the Fed knew there was a bunch of cash that was going to get thrown into the system. So they didn't want banks to have to worry about their excess liabilities during that time. March of 2021 rolls around and that suspension is set to expire so that it was going to go back to the normal rules. Jamie Dimon and everybody were saying, hey, Fed, you need to continue this suspension so that we don't have to worry about collateral. And the Federal Reserve just said, no, we're going to let it expire. So you do have to worry about collateral. And that was in March of 2021 there where you see that really start to be used. Because it sucked a lot of the cash out of the regular system in search of that collateral.
Yeah, and then what happened in June, if I recall correctly, is it was up here in the 800 billion range, and then the Fed started offering a yield on reverse repos, a 0.05. Mm-hmm. So all of a sudden, banks had this option for overnight money. If I just go give it to the Fed overnight, I can make 0.05. Well, overnight money, that's a great yield. It's better than zero. Mm-hmm. And all of a sudden it skyrocketed another 800 billion. Now it's up to, 1.6 trillion. It was briefly at like 1.9 trillion at the end of the year. But, my theory on this is the Fed is doing this to avoid interest rates going negative. If all that cash did not have that home of 0.05 of just, safe, easy money, just parking it with the Fed overnight each night or whatever their term is. Sometimes it's a couple days or whatever. where would it all go? Where would all this cash be flowing right now?
Yeah.
Odds are a lot of these banks will be buying short-term bills, short-term, some stuff that's expiring in the next, stuff that's maturing within the next 30 days. Probably, the
Right.
next 7 days to 30 days, they'd be putting this cash there. And that's enough cash where it could drive the short end of the curve actually negative. And I think the fear is if they drove the short end of the curve negative, that could affect money market funds. They could break a buck. And that would be, if the world reserve currency, if the short end of the curve went negative, I think that's what they're afraid of. And that's why they're doing this.
Yeah, 100%. And so I've talked about this a couple of times. And usually what I point out is, hey, it sucked all the cash out of the system because there wasn't enough collateral. But like to your point, technically there always is. There's always a price. And so if all that money had to buy bills, it would just drive the yield negative because that's so much buying pressure there. And so it does look like the Federal Reserve would increase the rate on this so that they could, you wouldn't break the global financial system by driving the short end of the down to negative rates there. On the flip side, so that's like a switch. So right now that switch is on where they're saying, hey, we need to keep this cash out of the system so that short-term rates stay high enough to not be negative. But they're planning on raising rates. They're planning on stopping their purchases off their balance sheet. They're planning on selling assets off their balance sheet, which means that at some point we could see the short end of the curve start to rise too fast. In which case, all they have to do is flip this switch off and all that money goes out there to counteract their monetary policy, right?
Yeah. Well, this is 1.6 trillion sitting on the sidelines, basically, or parked with the Fed overnight each night. So yeah, there's whether the Treasury needs to sell bonds or whatever, the Fed can play with these switches, as you put it, and send it into the economy or send it into the Treasury's bank account fairly easily with just some minor under the hood changes.
Yeah, it's really like it's not something that's a permanent solution, but if they're number one trying to not break financial markets around the world, and then number two, if they're trying to look like they're moving forward with their plan of tightening, then this gives them a huge buffer zone. If the markets, if interest rates start to go up too quickly, they can release this into the market and they can continue to tighten, but not see the direct effects of that. Hit interest rates at least for that first trillion, 1.5 trillion.
Yeah, and this plays into the Fed's balance sheet also. Is this where this is obviously the Fed's balance sheet, and as you just mentioned, they're talking about reducing the balance sheet, which will be really interesting to see whether they can pull that off. A lot of people are speculating this is the difficult part. You saw back during 2015 to 2017, Janet Yellen, when she was the Fed chairperson, she referred to as watching the paint dry. Remember that phrase? Yeah. And they were going to gradually just run off the bat. They weren't going to actively sell their bond. It's now up to what, 9 trillion, something like that. What's it at now? Almost 8.9 something trillion on the Fed's balance sheet. Well, back here when we were at like 4.4, they weren't going to actively sell them. They were just as they were maturing, they would just not buy new bonds. They wouldn't roll over the bonds into fresh debt. So they said it'd be like watching paint dry, and that worked for a little while, from about early 2018 until let's call it September 2019, the repo crisis. You've covered this. You've talked about this a lot, right? Yeah. And that's when it broke. All they could do was they were able to get their balance sheet down from 4.4 to 3.7, and then it just messed everything up. Everything was too tight. There wasn't enough credit in the system. And they had the repo crisis, which I'm sure you know a lot about.
Yeah, so they had a little bit of a buffer zone there from the economic growth and increase in asset prices across the board that was pricing in the tax cuts and jobs act. And so the buffer zone that the Fed is looking at this time, I think, is that $1.5 trillion in the reverse repo facility. And if they decide to start actively selling off of their balance sheet, they know that 1.5 trillion in the reverse repo facility is only going to look for the shortest term, like bills and stuff, then they can let their balance sheet bleed off at a very regular pace, with somewhat of an operation twist going on, where they're buying longer term, selling shorter term, knowing that that's what the market is going to eat up as they're pushing it out. So I think that there's, again, it's not a permanent solution, but they've got a lot of games they can play here, to the point where we could see this tightening game continue far longer into this year than a lot of people are expecting.
Well, that'll be interesting. They announced in November that they were going to stop buying bonds, or start reducing the rate that they purchase bonds to add to the balance sheet. But if you look at this line here, this is as they really haven't stopped that much. I mean, it's been like 3 months now since they announced it. I mean, and they're still buying. They were at 120 billion a month. They were buying. Now I think it's around 100 billion a month. I think the first step is they got to figure out how to stop buying bonds. And they're claiming they're going to do this by the end of March. So here we are. All right, 7 weeks to go.
Yeah.
The markets. A lot of people I interview on my channel are questioning whether they're going to be able to pull this off. You can't taper a Ponzi, right? It's how's the market going to handle this? How's the mortgage market? Because of that 120 billion a month they were buying, it was 80 billion a month in treasuries and 40 billion a month in mortgage-backed bonds. And we're already seeing, just with the rise in mortgage rates, a little bit of a slowdown in applications for new mortgages. I saw an article on CNBC that's down already, and they haven't even raised rates. I mean, so yeah, there's a lot of question marks whether they're going to be able to pull this off. A lot of people wonder with. I saw on CNBC whether that already the mortgage applications are down. So imagine once they actually really start raising rates, and the Fed's no longer buying any mortgage bonds. What's the market clearing price? What's that investors will demand for mortgage bonds once the Fed's no longer buying 40 billion a month of mortgage bonds? I mean, it's a big question mark whether this market can stand on its own 2 feet without that backstop of the Fed supporting it.
Yeah, 100%. And the nice thing is we can look back at history and we can see that typically in times like this, you want savings, but you don't want to save in something that's losing its purchasing power. You want to save in something that's maintaining or growing in purchasing power, which historically during times like this is precious metals. So it's nice to see that historical correlation there, and that we know there's a little bit of a safety line, a little bit of a lifeboat there in gold and silver that we can rely on.
Yeah, that's why we do it. 2020 was a great year for precious metals. 2021 started off great, but then went sort of sideways to downwards a little. So the second half of 2021 was kind of difficult for precious metals investors. Not going to lie about that, but the setup is there. The setup is there, and all the macro data points that we're seeing tell you gold and silver are primed to reach new highs. So, and it's not just that. I personally invest in the physical metals, primarily silver, not so much gold for me, but that's just where I am with my risk tolerance. But also the mining stocks and the exploration stocks. You buy the physical metal for an emergency. You buy the mining stocks for speculation, and that's how I play it myself.
Yeah. Or in other words, you buy the metal for savings and the stocks for investing.
Okay. Yeah. Investing. I buy I buy the really high risk ones. So
okay. The speculation then, right.
I mean, I buy the exploration stocks where there's no revenue. They're just raising money, going out drilling, looking for. So that's the really high risk end of the sector. But
Right.
there's a lot of great ones, the big mining companies that pay great dividends, very
Mm-hmm.
reliable cash flow, that are very low risk.
Mm-hmm.
So there's the whole curve from the big producers down to the junior exploration ones.
Yeah. Well, that's a great place to end. I really appreciate all of the charts that we looked at and all of the looking at the information and the data about what's going on right now. And again, for anybody who is not yet subscribed to Wall Street Silver's YouTube channel, I highly recommend going over there. Some of the best interviews from, you know, the biggest names in economics and investing. So go ahead and subscribe over there. Thank you again, Jim, for joining us today. I really appreciate it.
I want to also mention to all of Joe's fans on YouTube, Joe's got a great Twitter account. Everyone should be checking it out. Heresy Financial on Twitter. And our own Twitter account is Wall Street Silver on Twitter. So if you're active on Twitter, give those two accounts a follow.
Absolutely. I appreciate the shout out there. And thanks for joining us today.
All right. Have a good one, guys.
As always, thank you so much for watching. Have a great day.